You see this hand here? What do I look like, Andre Jik? What's going on, guys? We have a question today that I'm going to answer with the handy dandy whiteboard. Relapse. Can you revisit the options expiring and why that matters? I'm not a smooth brain. I'm a soldier. I need it real simple. Well, we're going to cover it real simple. What is an option? Why exactly does a day where a bunch of these options expire matter? And why you guys should watch to the end of this video, smash that like button until it reaches 1300, and comment out which number you were if we haven't gone to 1300 quite yet. And here we go. Relapse. What is an option? Let's say that the stock market acts in a certain way. You don't really know after a certain point. Let's ... all the way down to current time. This is now. N-O-W, right? This is the price over here, and this is time. I'll put a little clock here. As the stock market continues, you want to be able to extrapolate or guess where you think the market is going to go. Let's say that you want the price of a stock to reach $100, and you wanted to do it before Friday. So I'm going to expand out this market right here and say that now you have a brand new bet. You're betting on the market itself. You say you want to see this price of the stock reach $100 at any point. So that's a good point there. You can even reach it here. It could have gone here and reached it there. It doesn't really matter. The point is that now you are explaining to people who actually buy and sell the stock that you are playing a bet off of the stock market. That is a call option. You can also do the opposite with a put option, that you are going to expect the price of the stock to dip below a certain point. And so both of these options are out of the money. You can also buy in the money calls. And the only difference between those two is for a call, is your strike price, the price that you think it's gonna go, greater than the current price of the stock. If it is, then that is out of the money, OTM. If the price is greater, if the price is less than the price of the stock currently, then that's in the money. For a put, it's the exact opposite. Right? A put is the option to be able to sell a stock at a certain price, and if the strike price is greater than the price here, then that is in the money. So now you have a better understanding of what options are. Well, as we can see from Option Sonar, we have the opportunity to look at how many options are at every single strike price. So this is for GME for today, but we can look on like regular days, like let's say the 29th, where there's a very clear distinction between blue, which is the call options, and the black, which are the put options here. So we have the price action of GME somewhere between 170 and 180, and that's why the battlegrounds here is where the black and blue meet. But more often than not, we'll see most of the call options over on the right side. These are out of the money, and the put options are going to be on the other side. Right? These are out of the money put options here. Sometimes we'll be able to see in the money options, but all of these will have to expire one day. Remember when we made a ... to the x-axis in terms of time? That's the expiry date. And the reason why expiration matters so much is, let's go back to the whiteboard, that these contracts are going to be worthless if we hit that expiry and it's not currently in the money. Let's say that you bet that the price of the stock is going to go here, right? Well, if it reaches that price before your deadline, then you can sell the contract or exercise it. The difference being that you can either make money off of the delta. So you probably paid $100, which is your strike price, plus a premium. Let's say in this case, you probably paid somewhere around like $20 per share times 100. That is the total amount of money that you have to pay in order to exercise this call. And then you get 100 shares of the stock. The profit here is 100 times whatever the actual price of the stock is. So right now the price of GME is 180, so you would have made $180 per share, cost 120 for you, so that is a total benefit of 60 times 100, so that's $6,000 per contract, okay? The reason why this is important is because now you have an expiration date to make this money. You have to exercise this call whenever it is in the money. You can exercise it now, you can exercise it later, or you can sell it now, you can sell it later. The reason why people are putting so much importance on this expiration date, usually on a Friday, like today, is that everybody has their expirations on this day if they bought for this week, right? If you bought a contract expiring this week, it's going to expire this day, and now you are looking at a ton of volume, a ton of coerced buying from the hedge fund side. And really briefly, I've done a couple of videos already about what it means to have this gamma squeeze potential here from delta hedging. But let's say that you're on the other side of that transaction, right? You're the person that sold that call contract. The call contract is going to cost you money depending on how much the price of the stock increases. Let's say that you bought the $100 contract at $80. So this is the strike price, and this is the current price. So it's $80 right now. Let's use the exact same premium. That $20 premium in order to buy this contract means that the person that sold you this contract, either a market maker, institutional like financial like organization, or a hedge fund, someone who might be short on it. If you guys haven't seen that video about conversions and married put conversions, that's a way to be able to short a stock even if you don't short the stock. It's exactly the same effect. We have $20 in premium that they have to pay even if they don't exercise, multiplied by 100 per contract. So that's $2,000 that you've made right away. With those $2,000, you can buy 20 shares right away for free, right? And you do have to buy a certain amount of shares because you need to be able to make sure that you have hedged this bet. Up to a certain amount, right? Let's just continue to use numbers hypothetically. Let's say that since the price is currently 80, and there's a chance that it could reach 100 by the time that but before this contract expires, you might have to buy up to 80 shares out of 100, right? That means that out of pocket, you need to buy 60 shares because this $2,000, this actually technically buys a little bit more than 20 shares, but this $2,000 buys a couple of the shares, and then you have to buy the rest. 80 out of 100, while the price of the stock is at $80. As it continues to rise, let's say it goes up to 82, you might have to buy 2 extra shares. So you have to go up to 82 to match. And then if it goes down to 78, then maybe you sell some shares in order to stay delta neutral. All this to say is that when the price of the stock reaches the actual strike price, let's say that the strike price is $100, that's the price that the person wanted to bet that the stock would get to, and the actual price is $100. You can pretty much bet, in normal hypothetical situations, that the institution is no longer naked on this contract, is that they have bought all 100 shares per contract. And so this buying was happening with or without you because you bought the contract. It puts them at too much risk in order to not buy these shares. And since the Greek calculation, the different variables that goes into how many shares they need to hedge, depends on the date at which this contract expires. On Friday is when we see the most coerced buying action, because any naked contracts, any contracts that don't have these shares backing them by the institution, needs to be covered. If this video opened up a couple of the wrinkles inside your brain, I would appreciate a quick like of the video right now, and maybe a subscribe on our way to 100,000 subscribers. But the most important thing to remember about this video is that the options chain here is bringing you up step at a time, because these are different strike prices, right? And we can see a gamma ramp up to, let's say, $200 because so many people have put their faith at this strike price, $1 million in one day. This is just from the 29th of April. So on this day, $1 million worth of calls have been purchased here. And so as delta hedging increases the price of the stock, was that positive buying pressure from the delta hedging itself, you didn't do anything to be able to move the price of the stock up. All you did was hold the premium that you paid and that contract that you own. Now that said, a lot of ways you could end up hurting yourself if you don't understand the options chain more. So go ahead and make sure that you have turned on notifications for that TA 101 series that we're going to build your technical analysis chops. I want to thank the people that make this show possible, like the Moon Platoon, the Grillionaire, Meatball, the Space Legends Tears, and you for watching all the way to the end. I do appreciate that. So thank you for all of you and what you do, and we'll see all of you in the money.